Coming up on Business Incorporated, Kenya's debt service cost projected to cross the 1 trillion shilling mark this financial year. And Egypt's central bank postpones monetary policy committee meeting, initially scheduled for November 3rd. Plus, International Labour Organization projects global labour markets will deteriorate significantly in the final quarter of 2022. You're watching Business Incorporated live on Channels Television. I'm Ladi Williams. First off, let's kick off with the markets now. It's all positive sentiment in Africa as the NGX tries to stage a comeback up 0.03% there. We see the GSE there, 68,136 points. Let's move over to other markets we track. Egypt there, up 0.24%, 11,401 points. And we see Kenya there closing positive yesterday. We're seeing some bullish trends starting again in Kenya. And all negative at intraday in the Middle Eastern markets that we track. We see the Abu Dhabi index down 0.16%, while Dubai is also down there 0.13%. Let's flip over to Saudi Arabia and Qatar there. We see it's all negative there. Saudi Arabia down 1.57%, and we see Qatar index there continuing from yesterday's negative performance that we saw. So that's how it's looking right there in the Middle East. Let's move on to Europe now. We'll see Europe continues to battle the energy crisis, and Germany has made a unilateral move to introduce gas price caps. The measures are part of a 200 billion euro package to limit the impact of inflation. To find out more now, let's talk to Kate Ferguson right there in Berlin. Great to have you, Kate. Tell us more about the plans.
So the aim of these measures is really to help both ordinary households and these big industrial companies to deal with the rising cost of fuel. So right now, individual consumers in Germany are paying over twice as much for annual gas contracts than they were a year ago. And the price caps being proposed, they would save an average household around €1,000 a year. Now, on an industrial level, the caps would apply to about 25,000 big companies. And in this case, they are conditional on that company maintaining existing operations in Germany and also keeping 90% of jobs here for a year. That caveat, that's really important for the German government because it's been concerned that the energy crisis could be encouraging companies to move abroad or even to cut jobs. And we've already seen just how much this crisis is affecting these giants of German industry, like BASF, for example, which recently announced major cutbacks because of losses in its European operations. The government is still fine-tuning the details of these plans, but these are the main components: help for households and help with strings attached for big companies.
And other EU countries have criticized Germany's 200 billion euro plan to curb inflation. Why don't they like it?
So this really has a lot to do with this idea of a level playing field. EU officials are keen to tackle this crisis as a collective, and they don't like the idea of a country like Germany, which is richly resourced, going it alone. And it's an especially big issue because borrowing costs across the European Union differ very widely. It's much cheaper for the so-called frugal nations, that's like Germany and the Netherlands, to borrow than it is for southern countries like Greece and Spain. And up until recently, it was cheaper for all of the EU countries to borrow together than it was individually. Now, this has unfortunately changed. EU borrowing costs have risen above those of rich countries like France, Germany and Belgium. And that means they have less incentive to work as one. So it's just another example of national interests competing with the interests of the EU as a whole. And I think it's fair to say this is an enduring problem with the European project as a whole.
All right, we'll keep watching and see how the caps actually work out. But how is this playing out for the markets?
Well, investors have had a few pieces of bad news to digest. The latest inflation Eurozone numbers aren't giving them much hope. Prices rose over 10% in October. That was another record high. Analysts are also expecting GDP to contract in the fourth quarter with weaker consumer spending as people cut back because of inflation. Now, there's also supply chain issues and geopolitical tensions. They're still weighing on the markets as well. So that means the policy responses to the crisis, like the energy measures we've been discussing, are all the more important. Markets are really desperate for a sign that leaders have this crisis under control.
All right, thanks, Kate. We'll keep tracking those market outs. Kate Ferguson right there in Berlin, giving us the details, what's happening in Europe. Let's move on now to other markets. And in the UK, calls for windfall tax on energy companies keeps growing louder now. Let's talk to Juliana right there. So, Juliana, BP's quarterly profit, it's at £7.1 billion after gas prices surge. I guess it's a crime to profit from this surging oil prices.
Good afternoon, Laddie. A crime for some, yes, but if you're a BP shareholder, you're laughing your way to the bank this morning. And not just BP. As you said, BP have reported robust third quarter trading profits. And that follows what we heard last week from ExxonMobil, Chevron, as well as Britain's very own Shell. They've all done exceptionally well in the third quarter, following on from the second quarter. And this is all about pretty high oil and gas prices. The only problem for these firms, as well as they're laughing to the bank, you know, we've got consumers crying their way through their bills. Monthly bills have been increasing month on month, particularly energy bills, which is a big issue in this country, which is why Rishi Sunak, the now Prime Minister, former Chancellor, was kicking and screaming to impose this windfall tax, which the Conservative Party really didn't want to impose, but they did. They introduced it in May, and Shell last week didn't pay any windfall tax on the third quarter profits because there is a loophole, and that is if these firms are increasing their investment in and around the North Sea, they don't have to pay windfall tax. BP haven't put as much investment in as Shell have. So according to their trading update, I believe they paid $800 million on the profits they made in Q3. Rishi Sunak is determined to make, I believe, about £17 billion this year alone from the windfall tax. That's all going to go to supporting people with their energy bills. And we'll find out more when the Chancellor, Jeremy Hunt, does unveil that autumn budget, that much hotly anticipated autumn budget on the 17th of November. But you're absolutely right, Laddie. It does call for more windfall tax. We are expecting that perhaps there will be an extension announced on that Monday when we do hear more details about the autumn budget. But, you know, last week, these big firms collectively reported £40 billion worth of profits. So when we're talking about this global squeeze and economic meltdown, you just have to look at some firms that are doing pretty well when the rest of us are toddling along, shall we say.
Right, well, I guess we'll keep watching. I'm sure there's still more profits to be declared from other companies. But I know the Bank of England is supposed to start their gilt sales today. How's that looking?
Yeah, big story, actually, and it will be starting in approximately 90 minutes, 2 o'clock local time. The clocks have gone back, so we're not on the same timeline at the moment. We're on GMT time. But it is a big story because, of course, quantitative easing was a big feature during the pandemic lockdowns, and in fact, it started quite a while before that, just after the 2008 financial crisis. The Bank of England, in over a decade, have purchased nearly £865 billion worth of government debt, short-term and long-term. They have delayed the kind of selling off of these gilts. It was supposed to happen a couple of weeks ago, but then, of course, we had all the market turmoil fallout because of Liz Truss's mini budget, and the Bank of England had to buy short-term loans again to save the protection, to save the pension funds here in the UK. But they will begin selling these government debts off starting today at 2, I believe, to the tune of £750 million will be available to buy today. And then there are, I believe, 6 dates in the diary until the end of the year, so they can start clearing them all. So, yes, it is an important story to try and get the country back into some sort of international financial credibility, but we're still a long way off from there. And I think now we're all just waiting to see what the interest rate rise will be on Thursday when the BOE MPC meet at Threadneedle Street.
All right, I guess we'll be watching for when sales commence there. But how are the markets looking at this hour?
Well, London started off pretty well this morning, and it remains that way at intraday. We have had a boost from the BP update, even though their shares have dropped by about 0.57% on the rumour that perhaps that windfall tax will be extended during the autumn budget. Then Ocado, which is a kind of online techie supermarket grocery delivery store, they've just done a deal with a huge South Korean retailer, which is exclusive. So their shares are up 18.5%, which has really helped lift the blue chip index at intraday. The all share is up 1.55%, FTSE 100 up by 1.56%, and the FTSE 250, that domestic market, is up by 1.63%. In the currencies market, the British pound is still rallying against the US dollar. It's up by 0.65%. So at the moment, one British pound will buy you just above $1.15, well up from where we were a couple of weeks ago. The British pound is currently trading up against the euro too by 0.13%, but it's trading down at intraday against the Japanese yen by 0.36%, Laddie.
All right, Juliana, all eyes still on that British pound. Thank you so much, Juliana. I'll talk to you tomorrow. That was Juliana there with all the details from the UK. Let's move on to other markets now. We see stocks in Hong Kong led gains in the Asia-Pacific session after concluding the month of October with more than 14% loss, hovering around the lowest levels that's seen since April 2009. Back there, we see how the market in Asia there with Nikkei, they're up 0.33%. Shanghai, 2,969 points, up 2.62%. And to other markets now, we see the Shenzhen component, they added about around 3.24%, about 10,734 points after the Caixin manufacturing PMI for the country came in at 49.2, slightly better, than expected. The Reserve Bank of Australia raised interest rates by about 25 basis points for the second consecutive time, in line with expectations. The S&P ASX 200 rose by 1.65% to 6,976 points. Let's move on to the U.S. now. See, stock futures rose today, the first day of November, as Wall Street tried to build on last month's sharp gains. There we see Dow Jones Industrial Average, their futures 0.65% up. S&P 500 there almost close about 1% there. NASDAQ there 11,590 points, the biggest mover, up 1.25%. The rise in stock futures came as rates fell ahead of the Federal Reserve rate decision, as investors hope the central bank will ease its tightening stance in the months ahead. A better than feared earnings season continued with a strong report from Pfizer today. Let's move on to the oil markets now. See, oil prices rose apparent losses from the previous session as a weaker U.S. dollar offset widening COVID-19 curbs in China, stoked fears of slowing fuel demand in the world's second largest oil consumer. Brent crude for January delivery rose 73 cents to $93.54 a barrel. The December contract expired Monday at $94.83 a barrel. U.S. West Texas Intermediate crude as WTI rose 58 cents to $87.11 a barrel after falling 1.6% in previous session. Brent and WTI benchmarks both ended October higher, the first monthly gain since May, after the Organization of Petroleum Exporting Countries and Allies, including Russia, said they would cut output by 2 million barrels per day. And gold prices were flat today after touching their lowest levels in more than 1 week, as the dollar held firm ahead of the U.S. Federal Reserve's policy meeting. The central bank is likely to deliver another oversized interest rate. Spot gold is listed at $1,633 per ounce, having earlier touched its lowest level since October 21st. U.S. gold futures fell 0.3% to $1,636 per ounce. The dollar index is steady after rising 0.8% overnight, hurting gold's appeal for overseas buyers. U.S. central bankers are going to keep the inflation fight in high gear this week, even as they intensify the debate over when to downshift to smaller interest rate hikes to avoid sending the world's biggest economy to a tailspin. All right, we'll take a break now. When we come back, Commodities Market Update is next. Do stay with us. This is Business Incorporated. Welcome back. Still watching Business Incorporated live from Channels HQ. Now to the Commodities Market Update. We see China, world's largest real estate market, And it's experienced a boom in the building and construction sector since 2010 to the COVID pandemic of 2020. Its GDP recorded an average of growth rate of about in excess of 7% in the last decade. Recently, there has been a sharp slowdown in economic growth, leading to a fall in real estate values and growth, resulting in a 4% decline in steel consumption. Let's talk to Miriam Ode now, analyst at Financial Derivatives Company. Join us via Zoom. Great to have you on the program.
Hi, Ladi. Thank you for having me. Good afternoon.
Good afternoon, Miriam.
So China is not...
Yeah, let's start with effects. You know, what effect will this fall in demand for steel have on the global iron and steel industry?
Okay, so China is the world's largest producer and consumer of commodity steel, with contributing 6.7% and 56.2% respectively, both to the production sector and the consumption sector globally in the global market. So with the fall in consumption from China, we can expect steel price to fall. This is also supported by increasing supply from US and India, which are planning to add new steel-making capacity to their economy. The World Steel Organization has also reduced its output for consumption this year to 1.8 billion metric tons, as primarily due to the fall in demand from China. However, the fall in demand from China isn't the only reason for the expected fall in total consumption. Other factors such as inflationary pressure and higher global energy prices also weigh on this.
And in the past 40 years, you know, right here in Nigeria, we've invested more than $8 billion in the Ajaokuta Steel Complex, but we're not really seeing much of the benefits. When do you see, you know, some kind of turnaround? Because we're still importing, we're still a net importer of steel, you know, at this time.
I feel like the reason for the main reason for the suboptimal production in the steel industry from the Ajaokuta steel complex can be as a result of lacking external infrastructure to and from the complex. One example is the Warri-Ajaokuta rail line, which was supposed to be completed in order to transport iron ore to the steel complex. But with this lacking, it is hard for the steel complex to increase its production in steel due to lack of the raw material iron ore. Another factor that can be responsible for the suboptimal production in the steel complex is the lack of prioritization of high bulk building capacities at the port, which will help in the transportation of steel from the complex to other parts of the country.
All right, but according to the EIU, the global price of steel is expected to fall by about 17.4% from an average of $843 per ton in 2021 and about $696 per ton in 2022. And we know Nigeria spends about $4.5 billion, you know, on importing steel. Do you think this will affect our import bill? And, you know, what kind of impact can we expect for balance of trade?
Fall in steel price should result in a fall in the import bill, which is, and this will lead to a favorable trade balance, which currently, our current trade balance stands at 14.51 billion naira. Sorry, 14.51 billion naira. However, the current forex scarcity in the country could diminish this positive impact since the naira currently trades at 818 naira to $1 in the parallel.
All right. So thank you so much, Miriam Ade. We'll keep tracking that market, see how, you know, prices maybe stabilize at some point or get to a level that we can actually stop importing so much of that. Thank you so much, Miriam Ode, analyst, Financial Derivatives Company. Thank you.
Thank you for having me.
All right, let's move on to other stories now. See, Amazon Web Services company today announced the opening of its first office in Lagos, Nigeria. The new Lagos office is part of AWS's support for the growing number of customers and partners in Nigeria. The office will support organizations of all sizes, including startups, enterprises, and public sector agencies, and as they make the transition to AWS Cloud. The new Lagos office is AWS's latest investment in Africa. Teams of AWS account managers, partner managers, solutions architects, and other roles support Nigerian customers running everything from development and test environment to big data analytics. And the global labor market is expected to deteriorate significantly in the final quarter of 2022 as Ukraine's conflict and other crises continue, and that's according to a new report from the International Labour Organization. This latest edition of the ILO Monitor finds that the worsening labor market conditions are affecting both employment creation and the quality of jobs, pointing out that there are already data suggesting a sharp labor market slowdown. Meanwhile, the Director General of the ILO, Gilbert Humbo, explained that to tackle this deeply worrying global employment situation and preventing a significant global labor market downturn will require comprehensive, integrated, and balanced policies, both nationally and globally. And Egypt's central bank has postponed its Monetary Policy Committee meeting. It was scheduled for November 3rd. It was cancelled in light of the sufficiency of the exceptional meeting convened earlier this week. The MPC convened on Thursday, October 27, as it announced raising key interest rates by 200 basis points, durably flexible exchange rates, and gradually repealing the use of letters of credit for import finance system until completion of the removal process by next December. And Kenya's debt service cost is projected to cross the 1 trillion shilling mark this financial year and double to 2.1 trillion shillings in 4 years. Projections by the National Treasury show debt estimated to hit about 9.4 trillion shillings by June 2023. An annual public debt management report says the public debt will climb from 8.58 trillion shillings by June to 10.1 trillion shillings within 2 years. To rise alongside costs to service the domestic and external debt from 945 billion shillings in the year to June 2022 to 1.19 trillion shillings during the current financial year. That's the projection from the Treasury for June 2026. The amount will have doubled also to over 2 trillion shillings. And that's Business Incorporated today. Thank you so much for watching. I'll join you again tomorrow. I'm Ladi Williams. Bye for now.